Hello everyone, this is Evan here from the Trade Risk on Wednesday, November 2nd, here with our midweek market recap video. We are first going to analyze the current market environment. We're going to look at some other markets, sector analysis, and then finish off looking at some individual names. Now we have a lot to cover, so we're going to jump right into things. S&P 500 SPY ETF closed down 62 basis points on the day, and that puts us to down about 1.25% on the week. So sellers clearly in control here to start this week. Now, in our weekend video, we talked about the sort of significance or the interest in whether or not sellers could finally get follow through and break us below this, which is now kind of long-term support at 212.50. Remember, for the past couple of months, every time we've come back down here to test this level, we've gotten a bid, we've bounced for a few days, and we've managed to hold that ground until this week where we're finally snapped below it and we now find ourselves 3 points below this significant support. So support's been broken, momentum is to the downside, sellers are in control, there's no doubt about it, lots of technical damage. So there's plenty not to like in this market, which would suggest you'd want to be lighter defensive and a little more tactical or opportunistic right now, given the uncertainty in sort of this market environment. Now the upside or the opposite way to look at this is that we are now getting to points where we've historically bounced in the past. So one example, for one, we're down 7 days in a row based on today's close. So, by almost any metric, 7 days on one side closing is generally, a point at which a market tends to, slow down or at least move sideways and chop around. The other important point is a post I put up today on the Mcclellan Oscillator, which measures market breadth, and that is at a oversold level, which has typically coincided with market bounces and has been pretty accurate throughout 2016. And excluding January, where we found extreme pessimism and extreme readings for a prolonged period of time, every time the Mcclellan Oscillator has gotten to where it is roughly right now, we've seen at least multi-day bounces, or at least that kind of sideways working off overbought conditions with maybe a slight upward bias. So we have some things in place here to say that might suggest that we could see a little bit of stabilization here. Notice yesterday we were about $1.50 bounce off of the lows to close the day, signaling there was some interest down here. Notice also today, we did undercut yesterday's lows and then found a nice rally off of that intraday. We couldn't quite hold on to that rally. Would have preferred to see a close at least above 210. We didn't quite get that, but we did close 50 cents off the lows or so. So you can start to see a little bit of tails down here on the bottom end, looking like there might be some selling that's drying up at these levels. So you have a very interesting market where technically everything's going to point to damaged and to be sidelined, but you could be at a place where you have some type of short-term bounce that could start to materialize. I know that doesn't help dramatically. I think the point is you want to be lighter. If you want to play for a bounce, you want to just be in and out, be tactical, know where you're wrong, know when you're going to get out, and maybe position size accordingly. So zooming out, this is where we stand. Of course, we have earnings out for the rest of this week. We have the unemployment report out Friday, and we have the elections next week. So there's a lot for the market to digest and reprice and maybe panic about right now. So if it's getting its panicking out of the way right now, perhaps we have clearer skies ahead of us after we get through some of these events. So we'll have to see. For us, still playing it pretty defensively. We still have long positions on, but we are not, fully on, the aggression pedal, trying to load up the portfolio right now. Just waiting to see a more meaningful sign of reversal. Again, we have some clues, but not enough to really kind of sink our teeth in and play for some type of V-shaped reversal that might happen. So that's the way we're looking at it. If we start to move to some of these other indices, the IWM, so this is the first, this was the first clue. This ended up being the kind of true leader here as it started to break down last week. Remember, we talked about as it started to break below this 120.50 support line, which is a significant support line going back multiple years. As it started to break through that, it really hasn't looked back. It's just continued to slide lower and underperform everything, lead to the downside, if you will. And of course, now we saw the S&P 500 follow suit this week. The NASDAQ 100 holding up. It's at, more or less a point at which we were consolidating and found some support for the past couple of months. And it's perhaps a little overshot of that right now, so we'll have to see if it can stabilize here, but it looks vulnerable. It's also had a series of sell days here ever since last Monday, so it's in a tough spot too. Just like the S&P 500, it's sold off consecutively for 7 days. Might get a little bit of a kind of snapback, oversold bounce. Have to keep an eye on it, but technically still vulnerable. So that's generally equities right now, is a spot of vulnerability and a place to be, perhaps opportunistic, but again, only if you're a tactical trader. You can manage your risk, position size, know when to get out, but it's still just a lot of cross currents right now. So let's move into some other markets. TLT starting to try and stabilize a bit here. This is a bit of a safe haven. We've seen TLT sell off in recent weeks. 132 is a pretty significant support, was resistance, now support level. We broke below it, and now you can see we're almost right back to it. So be interesting to see if this last week's sell off below 132 happens to just be a little bit of an overshoot. If we can quickly start to get back above 132, I think that'd be interesting. At least give you a nice defined risk if you want to take a shot on the long side. Might be something to consider. Let's move into metals next. Gold over the past few days has been that kind of safe haven trade. We've seen a nice bid over this week, really finishing, well, we're up almost 1.7% on the week. Notice today we were a lot higher. We filled this gap back here, but we did close off of those lows. Doesn't look too actionable to me. This is a pretty sloppy chart. I mean, it was kind of wedging higher over the past several weeks. It accelerated higher and retested effectively this breakdown level. This 125 is pretty significant here for GLD. So keep an eye on that. It failed off of it right now. Let's see if it comes back down and just kind of catches its breath, but doesn't look terribly actionable to me right now. Silver, basically the same thing, was wedging higher over the past few weeks, accelerated over the past 2 days, saw a kind of reversal off of those highs. It's giving you just a lot of mixed signals and doesn't look like a high probability area for either of the metals. Let's go into oil now. This is what really got hit today hard and selling off significantly, pressuring, putting a lot of pressure here on the S&P 500. You can see ever since snapping, this was last week, below this 1130 level, it's just been a slide lower in this bigger range, and really this is now where we found support throughout mid-September, around $10 in USO. That's probably where USO wants to head over the short term, see if it can find some support in here once again, but for now this is kind of a broken chart. You need to give it some time to set up. Quickly accelerating lower. It's overextended to the downside, but doesn't look like a high probability area just yet. Keep an eye on $10. UNG also getting crushed. Natural gas started last week as it started to fall back into this old range, and it's essentially just accelerated lower since. It's actually falling now below the bottom end of this range, so this is making new multi-month lows. These are prices that we haven't seen since mid-June, so giving back a lot of gains. This false breakout definitely catching, or at least, trapping a lot of people up here and causing the acceleration lower. So natural gas, again, overextended to the downside, but you got to be careful trying to just catch this blindly. You want to just pay attention to your risk and understand, where you want to be out of that trade. Finally, I think we covered everything there that I wanted to cover. Let's take a look at some of the sector analysis. IYT, so the transportation average still holding up. It's holding up very resilient up here. Notice it's effectively at year-to-date highs. It's about 1% away, within a 1% range of year-to-date highs. So this is very constructive right now. You can see major resistance. It's basing underneath this. If this market does stabilize, I'd want to pay attention here. You're going to get probably a lot of stocks that are going to get ready to run and perhaps lead this market higher if we do get that bounce. So pay attention here. This is top of my watch list for sectors to pay attention to. Financials, they were hit today, but still holding up relatively well. Notice, these are pretty much year-to-date highs as well at $19.95. We're about 40 cents off of them. So we're not far from year-to-date highs here in financials. So you want to pay attention to those two. I think that's an interesting sector, even though, again, it sold off a bit today. And semiconductors, right? This is nothing new. This has been on the top 3 sort of sectors to pay attention to virtually all year. They continue to kind of stay resilient. You have a possibility of some type of rounding top here. They've had a hell of a move this year, so pay attention to them, but still holding up all things considered. On the downside, 3 sectors that are getting crushed right now. IYR, first and foremost, this is the real estate index fund here, ETF. This is getting hammered. It's been in a downtrend since August, since it made new highs in August. It's basically been making lower highs and lower lows. Broke below some significant support just last week. So at $76, underneath this level, you need to be cautious. It's really just kind of sinking lower. Looks like it's in trouble. It's vulnerable. You want to be careful there. I wouldn't want to be a hero trying to catch that. Healthcare. This has also been on this downslide for the past few weeks. It's been in a clear downtrend. Same thing since making not all-time highs, but highs in August. This has been rolling over, accelerating lower, oversold. But again, you want to be a little cautious there. And then finally, discretionary. You want to throw this into the mix. I think we talked about these, excuse me, last week. We flagged these as being weak and vulnerable ever since, basically failing to break out here throughout July and August, back below $80, and now it's breaking below the $78 level this week. So again, another new sell signal. Momentum to the downside. You got to be cautious here in this discretionary ETF. Now, let's look at some of those individual names. We'll start with Apple. It's been selling off. It did have earnings, not a big reaction off of earnings. I think it ended up finishing down 2.25%. But since then, it's slid lower. It's at support right now, overshot it a little bit. This 111, 112 area, this was where we found some support in mid to late September as some of those iPhone sales released. So you just want to pay attention to this general area, see if it can hold in here. Might be worth the trade off of support. I don't have any position on it, but I am paying attention to it. Google, here's another one that sold off post-earnings. Didn't have a earnings day reaction per se. It was just some volatility, closed flat on the day. And then this week, it's basically sold off. What are we down on the week? Almost 4%, and it's now challenging some very significant resistance, which has been support. This is the top end of a multi-year range. So this 788, 790 area, exactly where price is right now, is going to be very significant for Google to try and hold on to. If it starts to fail here and come back into this old range, that'll be a bit concerning there for the short intermediate term trend in Google. Netflix, getting a little bit of pullback finally. Remember, it's kind of post-earnings drift higher, just kind of melted higher all the way up to almost 130, which is almost year-to-date, almost all-time highs in Netflix. But it is cooling off a bit, which is healthy action. You want to see these moving averages still catch up. It still defended the gap nicely. Give this time to set up. I'm watching it for a re-entry here. I like the momentum created off of this earnings move. So we're going to see if that can continue, but need to see a little more proof of stabilization there before I jump in. Facebook reporting earnings after the bell, and it looks like it's not much of a reaction here. I'm recording this. It's now almost 4:30 Eastern time, and you can see looks like it's trading right around 126.70, which is almost where it closed. So I'd imagine earnings are out now. The call hasn't started, but you can see not much of a reaction. It looks like this support, this area could hold here. That is important, and that's constructive there for the bulls. Of course, it's a long way to tomorrow's open, so we need to see actually how this opens. But if we can hold on to 126, this general area, it's going to be constructive. It means it's going to maintain that upper level momentum and trend in Facebook. Move to Twitter next. Still moving sideways in this range. I mean, it's been pretty resilient. Hasn't sold off per se with the broad market over the past couple of days. So that is constructive, but it's still kind of lingering in here. It's anybody's guess as to how this ends up resolving itself. Remember, it got back here through a series of gaps. It'd be interesting to see how this resolves. You have very clear levels to use. $18, $18.25 more or less is your line in the sand on the upside, and then on the downside, if you start to lose about $16.50, $16.75, got to be concerned there if you're a Twitter shareholder. Finally, Alibaba, this one also reported earnings, I believe this morning or late afternoon yesterday. It finished lower on the day, ended up having a positive open, but you could see that completely faded. Back at some support level here, this $98. Be interesting to see if the bulls can kind of step in and support Alibaba. Remember, it was off to a multi-month run all the way starting from July. Just had a great move all the way from 75 to almost 110. So a big move, still holding up in the top 20% of that move, more or less. So healthy action. You just want to see where support really kind of steps in, where the bulls step in, and that could be an interesting trade back to the upside. So that's all I have for today. Hope this video helps. As always, thank you guys so much for watching. Have a great day trading tomorrow, and I will catch you next time.